What if I told you, you don't need to find the next Apple? You don't need to predict the next stock market winner. And you definitely don't need to spend hours analyzing company earnings to potentially build serious wealth in the US stock market. In fact, some of the world's most successful investors recommend something much simpler: index funds. But here's the problem: thousands of index funds exist. Some are excellent for beginners. Others aren't worth your attention. So if you were investing your very first dollar today, which index funds deserve a place in your portfolio? Let's find out why index funds are so popular. If you've searched for investing advice online, you've probably heard one phrase over and over: buy index funds. But what exactly is an index fund? Think of it like buying an entire basket of America's best companies. Instead of trying to pick just one winner, rather than betting everything on one stock, an index fund instantly gives you ownership in hundreds, or even thousands, of companies. That means your investment isn't dependent on a single business succeeding. If one company struggles, others can continue driving your portfolio forward. That's why millions of Americans use index funds for retirement accounts, college savings, and long-term wealth building. Why most beginners lose money? Here's where many new investors make a costly mistake. They chase the hottest stock. One week it's AI. The next week it's electric vehicles, then crypto, then something else. By the time they hear about it, the biggest gains have often already happened. Instead of investing, they're chasing headlines. History has shown that consistently predicting the next winning stock is extremely difficult. That's why many experienced investors choose a different strategy. They simply own the market and let time do the heavy lifting. Index fund number 1. The S&P 500. If there's one index fund nearly every beginner should understand, it's an S&P 500 index fund. This fund tracks approximately 500 of America's largest publicly traded companies. That includes businesses like Apple, Microsoft, Amazon, Meta, and many others. You're not betting on one company. You're investing in the strength of the American economy. Over long periods, the S&P 500 has historically delivered attractive returns, although future performance is never guaranteed. That's why it's considered a core investment for millions of long-term investors. Index fund number 2. Total U.S. stock market. Now imagine owning not just 500 companies, but almost the entire U.S. stock market. That's exactly what a total market index fund offers. Along with large companies, you also own mid-sized and smaller businesses. Some of today's small companies could become tomorrow's industry leaders. By owning the entire market, you don't have to guess who those winners will be. You already own them. That's one reason many investors appreciate total market index funds for their broad diversification. Which one is better? So, S&P 500 or total market? The truth is, both have historically performed similarly over long periods. The S&P 500 focuses on America's biggest companies. A total market index fund provides even broader exposure. Neither choice is objectively better. For beginners, the most important thing isn't choosing between these two. It's actually getting started and staying invested. What about technology? Some investors want faster growth. That's where technology-focused index funds become popular. These funds own many of the biggest technology companies driving innovation in artificial intelligence, cloud computing, semiconductors, and digital services. While they may offer higher growth potential, they also tend to experience larger ups and downs. That's why many financial experts suggest making broad market index funds the foundation of your portfolio. Then adding technology exposure only if it matches your goals and risk tolerance. The secret most people miss. People often spend weeks trying to find the perfect index fund. But history suggests that the biggest difference in long-term results often comes from behavior, not perfection. The investor who contributes consistently for 20 years often finishes ahead of the investor who constantly switches funds trying to chase better performance. Consistency beats perfection. Every time. Final thoughts. If you're just starting your investing journey, keep it simple. Focus on low-cost, diversified index funds. Invest consistently. Reinvest when appropriate, and give your money time to compound. Because building wealth rarely happens overnight. It happens one investment, 1 month, and 1 year at a time. If you enjoyed this video, subscribe to Wall Street Pulse for straightforward US investing, ETF, index fund, dividend, and stock market insights. And in the next video, we'll reveal the biggest investing mistakes beginners make, and how to avoid them before they cost you thousands of dollars. See you there.